Usually, while American and Chinese companies get all the attention in the stock market scene, we never hear about Europe's latest IPO. So, is this an opportunity to be a successful contrarian, or does the European stock market get the lack of attention it deserves? Throughout this video, we're going to be looking at blue chip stocks and growth stocks, and for tax reasons, whether you're European or not. I can see 3 reasons why you'd want to invest in blue chip stocks in Europe as a non-European resident. The first one being, it's a relatively safe way to diversify geographically. Classically, when we hear of geographical diversification, we think of emerging markets, and there are some risks associated with these markets. With old European economies like France, Germany, and all that, you have that diversification without the risks that are classically associated with investing in emerging countries. The European economy is a very old, very safe one, and while it has been severely hit by the 2008 financial crisis, it has slowly recovered, and it's a relatively safe way to diversify your money. The second reason is these European blue chip stocks, they're inflation hedged. See, your average European public company is probably not a tech company, unlike in the US or China. The advantage of these tech companies is that they get you huge returns on your money, but the inconvenience is that their valuations depend a lot on future expectations. And when inflation is up or interest rates are up, these future expectations go down. Which brings us to the third point. Most blue chip stocks in Europe are consumer defensive. If we take a look at Investopedia's page about consumer defensive stocks, we can read, a defensive stock is a stock that provides consistent dividends and stable earnings regardless of the state of the overall stock market. So well-established companies like Procter & Gamble, Johnson & Johnson, Philip Morris, Coca-Cola, etc. These are considered defensive stocks. So basically the bluest of the blue chip stocks. Europeans don't have the stomach and the risk tolerance that US people have when it comes to stocks. They see the stock market as just another way to generate cash flow, just like real estate. If the stocks go up in value, great. But the point of investing your money into stocks as a European is to get dividends. If we take the S&P 500 and compare it to the MSCI Europe, we'll see that the returns are much higher on the S&P 500. But on the other side, the MSCI Europe dividend yield is much higher. It's at 2.83%, while the S&P is at 1.83%. So in summary, if you're looking for a high dividend yield, an inflation-hedged economy, and a relatively safe way to geographically diversify your money, then European stocks might be good for you. But the trade-off is you're just not going to get as much return on your money as with US stocks. However, the case might differ for you if you live in Europe, because if you live in Europe, you might have tax shelter programs that encourage you to invest in European stocks. For example, in France, you can open what's called a PEA, which is the French equivalent of a Roth IRA. You can transfer up to 150k of your money in it, and all the gains that you make within that account are non-taxable if you take them after 5 years. So that means that in theory, as long as European stocks don't underperform the S&P 500 by 30%, you're winning. You pay less taxes, your money compounds faster, you're good. Now this is all good in theory, but how well does that hold in real life? Let's say that 5 years ago we were in this situation and wanted to put for 5 years your money to work. So you split it between the S&P 500 and the MSCI Europe. So on one side you get exposed to the American markets, and on the other side, you get exposed to, I think it's about 15 European markets, developed markets. And of course, at the end of it, you profit of the tax rebates on the European side. So what would your returns be, taxes accounted for? Well, in the past 5 years, the S&P 500 returned about 104%. So you take that 104, you remove the 30% of capital tax gains, and you get a return of 72.4%. So now all your European ETF has to do is beat 73% over 5 years. And with that, you have beaten the Yankees and their overvalued tax stocks with your government subsidized investing. Long live the European way of life. So how well did it do? 42%. So that means that if you put in 2016 100,000 euros on the MSCI Europe, you would have missed 31,000 euros in gains, taxes accounted for. And this is not some contrived example that I came up with. This has been happening over the past century. European markets have historically underperformed the American markets. That's just a fact. And this trend has been even more confirmed after the 2008 crisis, where European markets have struggled to keep up with the tech stocks back in the US. So unless, just like the non-European investor, you're looking for diversification and a stable source of dividend, I just don't see the point of investing in blue chip stocks, in European blue chip stocks. But what if you're not a blue chip investor? What if you're more of a growth stock kind of guy? Is Europe interesting to look at in that case? Yes, yes it is. Because we're very quick to say that the European economy is an old, slow one. The amount of stocks that have doubled in value last year is amazing. It's more than 100 stocks. In the US, that number is more like 7. NYSE and Nasdaq combined. And what's even more impressive is that these stocks, they're not just tech stocks. Now, of course, we live in the 21st century, and the argument can be made that any company is a tech company. But when I say that these are not tech stocks, I just mean that these are not mainly tech companies like software companies or something like that. The fourth stock, for example, is a biofuel company that returned 383%. The fifth one is a physical retail store company. When was the last time you heard of a physical retail stores company making it big? Most of these companies, their prices are very low, and I mean that in two ways. First of all, if your broker does not allow for fractional shares, like mine, then it can still scoop up these stocks at any budget. Most of them were trading at around 10 euros to 20 euros. The second way these stocks are cheap is that their valuations are actually pretty cheap. We don't have these crazy valuations that we get with Chinese stocks or US stocks. We have moderate European valuations because most European investors are into dividends. And so as long as the company doesn't offer dividends, we don't have this huge amount of attention on it. So first of all, if you're not a European investor and you don't have access to these tax advantages that come with investing in European stocks, this is still a very, very lucrative opportunity. You should get interested in these stocks, and most of them have English websites where you could go to the Investors Relations tab and read the reports, and they're in somewhat well-written English. However, if you're a European value investor and you have access to these tax advantages, then you're missing out if you're not investing in the European stock market. You're missing out on big gains. And honestly, I was just as surprised as you are when I figured out the values that I'm giving you right now, but more than 100 stocks would have doubled your money. The first few ones would have brought you back almost 4 times your money in a year. So if you do have access to these tax shelter programs that apply to European stocks as a European resident, definitely take them up on the offer. I'm definitely going to be putting more of my money and my time into European stocks because as a European resident, I'm definitely at an advantage here. But even if you're not a European resident, the gains here are still huge and worth exploring. In fact, I think the next video is going to be about one of these stocks in this list to see whether it still has upside or not. Many of these stocks that go hugely up in value still have upside even though we didn't catch the wave from the beginning. So we're going to investigate into that. So I'll keep you posted. But to conclude the video, blue chip stocks, European blue chip stocks, unless you're already invested into American blue chip stocks and you want some diversification, some safe diversification, I could understand that. But if you just want the returns on your blue chip stocks, I don't see why you do that. I don't see any financial reason to do that. However, when it comes to growth stocks, when it comes to value stocks, as the table shows, the numbers are very promising. I'll keep you posted. See you soon.